great to be here. Very good panel, I must say, two very successful entrepreneurs who've also managed to return money to investors. We also have an angel investor in Siddharth Ladsariya. So the objective of this panel is to basically understand exits from an entrepreneur's perspective, how they think about it, how investors can work out exits better, because it's often an area that's seen as lacking in India, that despite having so many startups and so many investments, exits don't happen as much as we want and in the way we want. So that's one thing that we're going to discuss, the challenges around exit, what the current scenario is. But I think before I get the investor perspective, I'd like to get the entrepreneur perspective, because both of them have built very successful businesses and also given exits. Jiten, for example, built up Citrus Pay before Nasper's PayU picked up a significant interest in it, and Ibibo, of course, acquired by Make My Trip. So just want to understand, did the exit happen because of pressure from investors, because you felt that you cannot scale it up beyond that on your own? Were there professional reasons, personal reasons? What were the combination of factors that made you feel like, okay, I'm ready to let go now? Because that's a very difficult decision for any founder to make. So did the pressure come from investors? And does the pressure always come from investors? Or do founders also sometimes, are they also open to exits? Your own sense of this.
Yeah, so you are right. It was indeed a difficult decision to sort of decide whether we should exit or not. But the decision was more influenced by a couple of factors, and the one which I would say is more around the ecosystem. So in the business which we were operating in, which is a payments business, generally it is profitable at a large scale, and we thought that so when we sold, we were processing like $2.5 billion worth of online volume, and to reach to a profitable scale, we knew that we had to at least double our volume. So when the whole Nasper's offer came in, what we saw is that two platforms coming together, the synergies which we could draw in the market, the synergies which we could draw in the efficiency around the operations, could achieve our ambitions faster. So frankly, we saw it as like 2-year fast forward. And that was a key reason, I would say, of exit. The second thing is the whole scenario around funding, the whole scenario around how the market was shaping or is shaping now. So you see the funding is getting polarized into a couple of large companies. So
it's getting consolidated with the top.
So while we had just raised Series C, actually 6 months before the exit, we had raised Series C. So we still had in our bank almost like $15 million. So it was never a pressure as such to exit, neither a cash crunch situation. But we sort of thought that while we were in a good stride today, and my thinking was you can never sell it highest, you can sell it high. So we were at like we had grown 3x in that year when we sold. So I think from a financial standpoint, everything was working beautifully well. But when we looked at
was there a particular trigger? I mean, did they approach you, or what happened?
So of course, we got the offer on the table from Nasper's, and that was, and when we looked at the vision which they had in terms of the business which they want to create in India, we were very impressed, and we found a clear alignment. Because they also believe that if you have to operate in any business, you have to be number one. And I think we had the similar aspiration that we wanted to be number one player. And as we speak today, we are number one payments player. So we grew more than 2x in last 1 year. So that clearly shows how this whole merger played out really well for the ecosystem. And personally, of course, I mean, it's an obvious call. So I think the business ambition played a key role in our exit.
Right.
So you asked another question whether there was any pressure from investor. Sequoia was our investor. So you'll be shocked that Sequoia actually tried to convince us not to sell, because they felt that it is little early. But at the same time, when we discussed pros, cons, we discussed that I think rather than just worrying about shareholder returns, let's just think about what is right for the company. And I think that sort of played out really well. And finally, they also bought in our arguments.
And they're thanking you now.
They thanked then, and they're thanking now as well.
Ashish, what about you? Because when the deal happened, people thought, this was the only solution, because the business was becoming so cutthroat, the competition between you and Make My Trip, that this is perhaps the best way out. Otherwise, both of you will end up, bleeding each other dry, because the competition in the OTA space had become really cutthroat at that point. So did that play a huge factor? Did you think that, this was a more sustainable way of building Ibibo going forward with Make My Trip?
So I think in general, if I take a step back, right, why do we build platforms? We build platforms to solve problems, create impact, and we also build to create value. Right. We don't just build it only for glory. And as I told you in the sidelines, I think it's our fiduciary duty to give back returns to investors. And I think that's
a strong statement coming from
I think
founder.
It is, right? I mean, just like the way I give my money to a mutual fund manager, just imagine if that mutual fund manager says, I don't feel like giving you your money back, or give me 4 more years, etc. Right? So my trust in the financial ecosystem will just die. So I think it's a fiduciary duty to give back returns, and and you give back those returns by building stronger financial fundamentals. So in a market like India, where per capita GDP is still low, which means your wallet sizes are small, though frequencies are increasing, volumes are high. It's in consumer internet play, typically multiple players don't play out. It is really 1.5 players, 1.8 kind of players, right? Which is what creates the right financials. So I think my thesis got proven, and it got proven because prior to the acquisition, Make My Trip was at 600 or 700 billion US dollars. At the acquisition, it became 3.4 billion. It also hit 4 billion. For the investment which our common shareholders put into me, there was multiple times return. And I think those theses absolutely got proven, and it just helped consolidate the market and also created the combined entity to create something massive and something pretty huge. So, as creators, entrepreneurs, we need to really put our egos aside. I know, we get touchy about the baby that we, gave birth to and built. And we need to be practical, and we need to give back returns, because we need to create multiple cycles. Right. And I think that's really what played out. In fact, the other point I want to make is it is the founders like Jitendra who need to take that call, because many times when investors try to orchestrate, you've seen what's happened in something which we just discussed. It's just really hard, right? Because it's the founder who's running the business. So I think investors can
end up making them the villains.
I think investors can orchestrate when there are like 2 losers and bring them together, right? So because the stakes are so low, or 1 loser and 1 big guy. But when there are 2 strong companies to be brought together, or in the food chain, 1 large company to buy a complementary large business, I think in general you have to have the endorsement of the founders. Right. On the table.
But what you say, that it's an entrepreneur's fiduciary duty to return money to the investors, but we end up glorifying founders most of the time. And I mean, it's not wrong, because without the founders you wouldn't have companies where they are today, and they've been source of wealth creation even in the valley. So is that thinking there today among the founders, that you see that it is our duty to give back money to investors? Maybe it wasn't there, say 2014, 2015, but is there a more mature thinking now among entrepreneurs you meet, founders you meet?
Yeah. So look, so 2 points out here. One is that I think I have personally now seen 2 or 3 cycles. So I bought Red Bus. Right. And acquisitions can go wrong, and I wanted to make it successful. Because again, I put $100 million on the table. So, I think that's a great example. And then I have done this exit. so which also sets the right example. I think one mistake which you are doing, or media is doing, is too much of celebration of fundraising. Fundraising is not a celebration event at all. In fact, I'm like, right now, whatever next I'm going to do, fundraising is something which I don't want to celebrate, right? Because that's the day when suddenly, you know, my responsibilities begin, right? The clock starts ticking. And what has really happened is, if you look at the pink newspapers, the celebration and making heroes out of people for raising funds and raising large funds, you know, that has gone overboard. And that has no semblance to what is going to happen.
Yeah. Media is always blamed for everything.
I'm just saying a little balanced approach. Okay, maybe not media, maybe whichever constituents, but I'm just...
Founders are very happy to talk when they raise money. I mean, they are not, you know,
so
depressed.
exactly. So I'm just saying that at that time, the way you do, what you should do is you should be looking at what is your NAV. Everybody understands what is an NAV, right? What is your NAV? That day you see the whole mood changing, and that day you see how the responsibilities will move and the dialogue will shift.
Right.
So I think in general, that dialogue needs to move from celebrating, you know, funds being raised, $1 billion being raised, 100 million being raised, to, you know, what is your current NAV, you know, what is your performance metric, you know, what are you doing? Because I think the problem is that the larger funds you raise, you need to give the right IRR. Right. And as a result, now your fiduciary duty becomes even more difficult.
Jitin, in terms of exits, you know, when you look at the India scenario, everybody is constantly talking about how you know, huge number of startups, lot of investment, especially in the last 5 years, it's really taken off. But exits are not happening at the same pace. And whatever you've seen, I mean, you know, you can't even call them acquisitions. They're basically acqui-hires that we've seen in the last few months, except for a few strategic investments that we've seen here. Why do you think it's so difficult to get an exit in the India market, and is that changing today?
So I would say it's a factor of maturity of ecosystem. So what I mean by that is, I think everyone when look at India and they compare India market to China or US. Now what they don't factor is the spending power of consumer in China and US. I mean in China itself, the spending power of consumer is 6x as compared to India. So the ecosystem to mature in terms of those companies to make money from consumers or from enterprises itself is limited today. So from that perspective, I think when someone is expecting that they should start seeing exits in India, I would say if we talk the same topic 5 years down the line or 7 years down the line, we'll be talking, oh wow, this guy exited. Like you will find like Ashish and me, the whole gang here. So who have exited their companies. So and we will be like, these are the old guys sitting here. So what I'm trying to say is, I think we are putting cart before the horse, expecting too early to things to happen. I think this is a beautiful time where entrepreneurs should focus on building the business for long run, rather than for 4 years or 5 years or 7 years.
In fact, I was just coming to that. I mean, if you look at it, investors who've held on for a longer timeline, you know, not the typical 5 to 7 year, but perhaps 10 years or more. I mean, Saif has held on to Paytm, I think, for over a decade. And, you know, it's a similar story with Tiger and Flipkart. So should we treat the India scenario differently, wherein the timeline is perhaps longer than, you know, the Western market, a 10, 12-year time frame before you get a very good exit? And are investors patient enough to sort of back their companies through multiple rounds of funding till they are confident that, you know, we can get very good returns?
So I think this answer is also sector dependent. So sector which are just maturing. So if you look at the sectors which are like internet one, I think the internet sector has just started getting the growth, which is Reliance Jio giving so many internet connections, so the Airtel penetrating in 4G. So you will see the longer duration will give you better returns. But let's say the sectors like consumer durable, which is like somebody selling beer or somebody selling a mustache, beard, shaver, or whatever. So I think those kind of markets are already evolved.
Right.
So there you will see probably a 5-year, 6-year return scenario.
What do you think, Ashish, in terms of why it's difficult for exits to happen in India and in the way you want it to happen?
So I think every market needs to have a food chain. So
Okay.
food chain is these platforms which will acquire platforms and assets, and those assets which will further acquire, right, basically. So a large platform which will acquire another company for a complementary reason or for a competitive reason or whatever the reason being, right? And also, on the other hand, companies reaching a scale to be able to list in the public markets. So first good news is we are beginning to see. So you've seen, 2 exits. You've heard Nazara going IPO. You've heard Bharat Matrimony go IPO. You've heard the Ahmedabad e-commerce company, Infibeam, which has got listed. So I think many, many more companies in the future are going to get listed. And I think there are going to be, in the food chain, many large platforms will get set up, which will be able to acquire and drive hundreds of exits.
But in the last year, with an entity like the SoftBank Vision Fund that has $100 billion, will we see more of secondary deals happening? I mean, that's what we've seen, in the last year. Is secondary transaction going to be the primary mode of exits going forward?
Yes, so again, as they were saying, the ecosystem needs to mature, and with the end, so we got our major exit due to SoftBank's Vision Fund. So
now, I think everybody is going to get an exit because of SoftBank.
So I cannot complain much about that, but yes, we are seeing a lot of exits because of these bigger boys, as you call them. And